I am AI Avtar of CA Ratan Mundra. This case relates to a recent enforcement action taken by the International Financial Services Centers Authority in June 2026 against Ashoka White Oak Capital Management GIFT LLP, earlier known as White Oak Fleet Street Global Investment Advisor LLP. The regulator imposed a total penalty of N lakh rupees for multiple regulatory violations observed during inspection. At first glance, the penalty may appear small, but the regulatory implications are significant for all IFSC entities. The case highlights how even minor deviations from licensing scope can lead to enforcement action. It also shows how regulators in GIFT IFSC are increasingly focusing on substance over form. The key issue was that the entity engaged in multiple financial activities without proper authorization. These included investment advisory services before registration, distribution-related activities without registration, and ancillary services without separate approval. Additionally, the regulator identified conflict of interest concerns. In this video, we will break down each allegation in detail and understand what went wrong and what could have been done differently. The entity involved in this case was registered as an investment advisor under the IFSC regulatory framework. Like many financial advisory firms, it was engaged in setting up operations for investment advisory and related services in GIFT City. However, during its early operational phase, the company entered into multiple business arrangements even before obtaining full regulatory approvals. The inspection conducted by IFSCA revealed that the entity was not only providing advisory services but also engaging in distribution support and administrative financial services. These activities were performed through different agreements with group companies and external clients. The regulator observed that the business model was evolving faster than the regulatory commissions granted. This mismatch between business operations and licensing scope became the foundation for the enforcement action. The case demonstrates the importance of ensuring that every activity aligns strictly with the registration status granted by IFSCA before commencing operations. The first and most critical allegation relates to investment advisory services provided before the entity was officially registered. IFSCA identified communications dated January 4, 2021, in which investment recommendations were shared with a client entity named Dux. At that time, the firm was not yet registered as an investment advisor, and the registration was granted only on March 5, 2021. Despite the absence of registration, the communication clearly contained investment recommendations. The entity argued that these were only exploratory discussions and no formal advisory relationship existed. They also claimed that no fees were charged and the communication was part of general market discussion. However, IFSCA rejected this defense. The regulator emphasized that the key factor is not whether payment was made, but whether advice was given. Even a single instance of personalized recommendation qualifies as investment advice under regulatory definitions. This makes it clear that pre-registration activity, even if informal, can lead to serious compliance violations. The case reinforces that regulatory approval must always precede advisory communication. The defense presented by the entity primarily focused on the absence of formal agreement, absence of fees, and lack of commercial intent. However, IFSCA evaluated the content of the communication itself rather than the context in which it was shared. The regulator applied a strict interpretation of what constitutes investment advice. The presence of investment recommendations directed towards a specific party was sufficient to classify the communication as advisory activity. The defense failed because it did not address the core regulatory test, which is the nature of communication rather than its commercial structure. Even if the communication was exploratory or informal, the presence of actionable investment suggestions made it advisory in nature. The regulator therefore concluded that investment advisory services had already commenced before authorization. This highlights a critical compliance lesson that intent or payment structure is irrelevant when the content itself falls under regulated advisory activity. The second major allegation relates to distribution-related activities undertaken by the entity without obtaining proper registration. The company entered into a fundraising support services agreement with ADEPA, under which it was involved in identifying investors, facilitating introductions, and coordinating communications between investors and fund managers. The agreement also included fundraising support services and resulted in distribution-related fees. IFSCA observed that these activities clearly fall within the definition of distribution services under IFSC regulations. However, the entity did not hold a distributor registration at the time of providing these services. The defense argued that the services were merely advisory support and did not involve direct selling or solicitation. They also stated that sophisticated institutional investors were involved and no retail harm occurred. Despite these arguments, the regulator focused on the actual contractual obligations rather than the terminology used. Since the agreement explicitly included investor identification and fundraising support, the activity was classified as distribution. This demonstrates that regulatory classification depends on substance, not naming conventions used in contracts. The third allegation involves ancillary services provided without proper authorization. The entity entered into an agreement with AWCPPL under which it provided NAV reconciliation, trade reconciliation, and various administrative support services. These activities were carried out as part of the overall business structure of the firm. However, IFSCA determined that these services do not fall within the scope of investment advisory services. Instead, they are classified as ancillary services that require separate registration under IFSC regulations. The entity argued that these services were incidental to its advisory operations and were not offered independently to clients. They also claimed that no separate fees were charged for these services. Despite this, the regulator held that the nature of the activity itself determines its classification. Administrative and reconciliation functions are operational in nature and cannot be treated as advisory services. Therefore, separate authorization was required. This highlights the importance of carefully evaluating all support functions within a financial organization to determine whether they require additional licensing. Another major concern identified by IFSCA was the presence of conflict of interest and lack of proper operational segregation. The entity was simultaneously involved in advising investors, investing in the same fund, and providing fundraising support for that fund. Additionally, the same personnel were handling multiple regulated functions, including advisory, distribution, and administrative services. The regulator observed that such overlapping roles create inherent conflicts of interest. Even if no actual harm is proven, the structure itself creates risk to investor protection and market integrity. The entity argued that it was a boutique operation and that functional independence existed in practice. However, IFSCA rejected this argument, stating that regulatory requirements apply regardless of entity size. Proper Chinese walls, segregation of duties, and independent compliance functions were expected but not adequately implemented. This case reinforces that conflict management is not optional but a mandatory regulatory requirement in IFSC operations. IFSCA imposed a total penalty of 10 lakh rupees in this case, divided into 5 lakh rupees under Section 15EB and 5 lakh rupees under Section 15HB. The regulator clarified that no investor loss or market manipulation was observed. However, the penalty was imposed due to repeated regulatory breaches over an extended period. The violations included unauthorized advisory services, unregistered distribution activities, ancillary services without registration, and conflict of interest concerns. The regulator also considered the duration of non-compliance, which extended for more than 2 years in certain activities. While the penalty may appear moderate, the regulatory message is strong. It signals that compliance violations in IFSC will be treated seriously even if financial harm is not proven. The objective is preventive enforcement rather than punitive recovery alone. The order provides the entity with the right to appeal before the Securities Appellate Tribunal under applicable provisions of the SEBI Act as extended to IFSC entities. The possible grounds of appeal include reclassification of services, proportionality of penalty, and interpretation of regulatory scope. The entity may also challenge the factual characterization of distribution and ancillary services. However, since contractual documentation strongly supports the regulator's findings, a complete reversal may be difficult. A more realistic outcome could be a reduction in penalty or partial modification of findings. Appeals in such cases typically focus on interpretation rather than denial of facts. Therefore, the strength of documentary evidence becomes a key factor in determining success at the appellate level. This case provides an important lesson for all IFSC entities operating in GIFT City. The regulator consistently applies the principle of substance over form, meaning that the actual nature of activity is more important than how it is described in agreements. Businesses must ensure that all required registrations are obtained before commencing operations. Every agreement should be reviewed from a regulatory perspective to determine whether it falls under advisory, distribution, ancillary, or other regulated categories. Strong internal controls, segregation of duties, and conflict of interest management systems are essential. Even small compliance gaps can lead to enforcement actions. The safest approach is to align business expansion with regulatory approvals and maintain continuous compliance monitoring. Ultimately, preventive compliance is always more effective and cost-efficient than dealing with regulatory penalties after the fact. Moon Says and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence. A pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA. Comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.